the class, anything relate with your mini CC or whatever that you want to ask me? Anything? Any questions that you have? You can hear my voice, isn't it? Imran? Imran? You can hear my
Yes,
voice.
I can hear your voice.
Okay,
Yes.
so no questions, huh? So we proceed with the notes. Okay, so we just want to stop sharing. Hope that already all of you already scanned for the attendance. I'm going to stop this one. So we're going to proceed with your notes. Okay, notes here we have two part. The part one is we have a few slides to cover. So we're going to look at on that one, yeah. So this one is already part two. I just want to find the part one of your notes. Part one of the notes. Okay. Okay. Stop sharing that one. I'll try to share another one. Sorry, do you have this one? Part one. You can see this one, part one now. My Sarah? My Sarah, okay. I'm going to proceed with the notes. Okay, so I just want to post this one. Okay, so we're going to proceed with the notes. Last time we stopped until the which part now? The hierarchy, isn't it? The hierarchy of the inputs. Okay. We stop up to the hierarchy of the input, isn't it? Any of you? Okay, so we're going to proceed with that one. Subject. Okay, we're going to proceed with the hierarchy. Okay, slide after hierarchy. So we move to the next one. Okay, we start up to this point last time. Okay, so this is what we had stopped last time about the hierarchies of the input. So a summary from what we have learned last class is about the introductions. Just want to highlight a few important parts that you need to know for the fair value for the last class. Okay, the first thing that you need to know is the definitions of your fair value. Definitions of fair value. So for definitions for fair value, three things that you need to know. The first one is the exit price, and then the second one is relate with orderly transaction, means that there is no force for the transaction. And then the last one you need to know about the market participants in the definition itself. Okay, after that we learn about the four step. Okay, the four step we have the first one is relate four step to measure the fair value. So the first one is relate with assets or liability that are going to be measured. And then the second one you have valuation premise. Okay, for valuation premise we have two tabs here. The first one you need to determine the highest best use. Highest best use based on market participant view. Based on market participant view. And then the second thing, when you want to value the asset, whether the asset is stand alone or combinations of assets. Okay, in the valuation premise. And then the third one is about principal and advantageous market. Okay, for principal market is the highest volume or activities, level of activity. And then for advantageous market, we're going to calculate it based on formula, the selling price minus transaction cost minus transportation cost. And then the advantageous market we choose here is based on the highest net proceed. Net proceed is to calculate the net proceed here based on this formula. Okay, the net proceed. Okay, and then after that we're going to look at the last part that you have for the fourth step here is to determine the valuation technique. Okay, for valuation technique we have three methods here: the income, the cost, income, and market methods. Okay, approach. So we're going to choose this one. Which model that we are going to use here is depend on the inputs. Okay, depend on the input. So the inputs we have three level: level 1, level 2, and level 3. Level 1 is from quoted price. Level 2 here is still quoted price, but that one is similar assets, similar asset. Okay, and then level number 3 here is only based on judgments. Level 1 and level 2 is observable input. Level 3 here is unobservable inputs. Okay, that is what we learned last class. Okay, so I'm going to proceed with the notes. Okay, so what do you have there? Laura, another Laura, and Laura, and Laura. Okay, what happened there? Okay, never mind. So we proceed, Laura. Laura. Okay, so we're going to proceed with the notes. Okay, we're going to proceed. The next slide, slide continue from this one. Okay, so now we're going to look at the applications of the fair value to the liability. Prior to this note, we focus on the how we're going to measure your non-financial asset or your PPE. Okay, and then we look at this one for a liability. For a liability, prior to the standards, the introductions of MFRS 13, the measurement is based on the amount required to settle. Okay, amount required to settle. Okay, that one. And then we are using the word settle for a liability. We are using the word settle. This one is prior to the introduction of MFRS 13. Okay, according to the FRS 13, once this standard was introduced in the year 2013, they changed the word settle to transfer. To transfer the liability. The fair value is the amount paid to transfer a liability. Transfer here means that you want to transfer the liability from one market participant to another market participant. Fair value measurement assumes that the liability is transferred to another market participant at the measurement date. The standard ISB argued that the fair value of liability from the perspective of market participant who owe the liability is the same regardless of whether it is settled or transferred. So either one. Sometimes they use the word transfer, sometimes they use the word transfer, but that is the same. Okay, but the thing that you need to know here is the transfer of for the fair value going to transfer here is from one market participant to another market participant. Okay, and then move to the next one. Okay, the next slide. Okay, so how we're going to apply this one, financial fair value for the non-financial liability. There is often an observable market and a quoted price, okay, to measure the fair value of the liability. So means that for financial liability, most of the time we are having the input level 1, because it's offered have observable market and a quoted price. Measurement will be depend on whether there are or not a corresponding asset is held by another entity. What is a corresponding asset here? So let's say you have two parties here, A and B. Let's say A issue a bond. Okay, issue a bond. So when A issue a bond, this bond to A is a liability. Okay, a liability. And then this bond was issued, and then this bond was bought by B. So when B bought this one, okay, issued to bond to B. So B for B, it become an investment. Okay, investment. So when it become investment for B, this bond is an asset. So this is what we mean by corresponding asset. So the liability for one party, the other party become an asset. Okay, this is the for A, the bond is a liability because A is the one who issue it. And then for B, once the B bought that bond is considered as investment. So for B, that investment is an asset. So we're going to measure the liability here. Okay, we're going to measure this liability based on this asset, based on asset that we have here. Okay, so we're going to look at when we have a corresponding asset. The measurement should be in the following order. So when you have a corresponding asset, to value the liability will be based on the quoted price of the asset in an active market, or a quoted price of asset in an inactive market, or if you don't have this one information, the first one and the second one information, then we're going to apply the valuation technique. So valuation technique, most of the time we are using here is income approach for a market approach. Later on, we're going to look at the examples. Yeah? Okay. So if you have an asset, corresponding asset, then the liability going to measure based on the value of the asset. So the value of the asset will be determined based on the quoted price. If there is an active market, if there is not active market, so you can use the quoted price. But if not, if there is observable input that you cannot find here, then you go for a valuation method. So valuation method for the liability, we are using the income and the market approach. Okay, and then for the non-corresponding asset, if there is no asset relate with that can be relate with that liability, the measurement must be done by applying a valuation technique. So we only can use a valuation technique. Either that one is a income approach or a market approach. If there is no assets, okay, and then normally we're going to use a present value techniques. Normally the present value techniques here based on the income approach. For the present value technique, if you still remember last time we learned about issuance in under financial asset, that you have the debt instrument. When you issue a bond, when you issue the bond, you need to calculate the present value. Okay, so for present value, they have the first one is present value of the principal, and then the present value annuity of the interest. So based on the value of your debt here, you base on the present value techniques. We have example for this one. Okay, on 1st January 2015, Cola Limited issued a par value at par a private placement of 2 million fixed year debt instrument with an annual 10% interest coupon rate. So it's issued at par. So issue at par here means that the par value, when they issue a par here, the market value, okay, the nominal value here, okay, nominal value is equals to the market value because you issue at par at the rate of 10%. Yeah. Okay, and then on 31st December 2015, Cola carry BB. This is a bond, the bond safe debt instrument considered as a BB credit rating. So this BB credit rating is example of types of bond. Yeah. The market conditions, including interest rate and credit spread of the B quality credit rating and liquidity, remain unchanged from the date of the issuance of the debt instrument. However, Cola Limited credit spread has deteriorated by 50 basis points because of the change in its risk of non-performance. If the instrument was issued on 31st December 2015, the instrument would need to have an interest rate of 10.5%. So means that when there is a risk in that liability, the interest rate will be increased. If you compare here at the beginning of the year, there is 10% now. But when there is a risk here, risk of non-performance, then the rate was increased. So when the rate was increased here, it means that the value of bond will be reduced. Okay, increase means that value of bond will be reduced. Value of your debt, okay, will be reduced. Okay, so we need to find what is the new value. Okay, the new value, because at the beginning when you issue, we issue a par. Par means that your nominal value is the same as a market value. And then when there is a changes in the risk, and then the risk, not the changes in the risk, because of the risk there is a changes in the interest rate. The interest rate has been increased, so when there is an interest rate was increased, it means that the value of that will be lower. So how are we going to prove that one? We need to calculate using a present value techniques here. Okay, for the present value techniques here, okay, we need to find the present value of the debt by looking at the present value of the nominal value or the face value of the bond. So you have 2 million here times 0.67. 0.67 here is the PV. PV when your I here is 10.5%, and then your N here is 4 year. Why 4 year? Because this is already at the end of the year 2015. Yeah, so we need to use this one. So the remaining year that we have here is only 4 years. Okay, the present value here is 0.67. So you have 1.3 million. Okay, and then remember that we have two elements for present value. One is the nominal value and the face value, and then the other one is a interest. So this one is an interest element. So the interest element, this one is a face value or nominal value, and then this is an interest. The interest that you have here is 10% times with 2 million. Yeah? So you have 200,000. 200,000, since the interest is incurred every year, so you are using the present value annuity table. So 200 here times with 3.1, so you have 627. So you total up here, you find that the amount, the fair value of the bonds here is only 1.9. Yeah, as compared with this on 1st of January, the fair value here is 2 million. At the end of the year, the fair value is only 1.9 million. Why we have this one? Because of the increase in the interest rate. Yeah. Okay. So, and then we have non-performance risk. So what is a non-performance risk here? The non-performance risk here is the risk that the entity will not fulfill an obligation. So that is the risk of entity cannot perform. So when they cannot perform means that they cannot fulfill the obligation to the maybe to the borrower. Okay, for non-performance risk include but not limited to that entity own credit risk. Entity own credit risk. So that one is a non-performing risk. So when you want to value your liabilities here, the things that you need fair value of liability here will be based on the either we have a corresponding asset, without a corresponding asset, and then you also need to look at the non-performance risk. So three factors that needs to be considered when you want to value the liability. Yeah? Either that one is through the corresponding asset. This one is normally we're using the quoted price. For non corresponding asset, we're going to use a present value method. Okay, for the non-performing risk, when we have a risk here, when we have the risk, the value of the debt or liability here, value of liability will be lower. Okay, because of the risk. Next one, we look at the applications of equity to the equity instrument. Okay, for the equity instrument, how we're going to measure this equity instrument may be needed. You want to need to measure the equity instrument when you are in the process of a business combination. So business combinations here is when the one of the company we call as a parents. Okay, parents bought a other's company. Okay, the others company, new company here. This new company here is a subsidiary. Yeah? Okay, then they have a relationship between parents and subsidiary. So that is a business combination. Yeah. Okay, and then an issue is related with own equity investment in exchange for the business. So parents, when they want to buy a new subsidiary, they're going to revalue the investment, the equity that they have in the company. Okay, when parents bought a new subsidiary, we're going to have a parents and subsidiary relationship. And then in a financial statement, then you can find two things that we have here. One is information regarding the company, and then the other information here is regarding a group here. Okay, information about the company is information about the parents, the financial performance of the parents or the financial statements of the parents. But for the groups here is a parent plus subsidiary. So already combined the parent and subsidiary. When you want to analyze the performance of the company here, we're going to analyze based on groups. Okay, the principle in relation to liability also apply to the equity instrument. Means that how we're going to value the equity is similar like what we used to value for the liability. Yeah? The company must measure the fair value of the equity instrument from the perspective of market participant who hold the instrument as an asset. Okay, we need to value our shares, the company share, based on the market participants who hold the asset the equity as an asset. Yeah? Similar like the one that you have for a liability. Yeah? Okay, and then when you have to measure the financial instrument. Okay, measurement of financial instruments is detailed in chapter 4. I'm going to look at the chapter 4, but this one is we just want to look at the offsetting position. Offsetting position is exists when The entity hold both financial assets and financial liability that are exposed to the same risk, market risk and credit risk. Both of these financial asset and financial liability are exposed to the market risk and credit risk. Where these assets or liability are managed as a group, the standard allows an entity to measure the net financial assets or the net financial liability. So in these situations here, examples here, you have both. You have financial asset. Let's say your financial asset is 10,000. Okay, and then at the same time, you also have a financial liability. The financial liability value here is, let's say, 7,000. Okay, this is what you have. Okay, for the purpose of presentation, okay, presentation in financial statement, okay, in financial statement, this standard, the standard MFRS 13 allow for the net offsetting. Offsetting means that you can report in the net assets or net financial liability. So in this case, based on this example, so your financial asset that you have here is 10, and then financial liability that you have here is 7. When you offset these two figures, you're going to have the figure of 3. That 3 that you have here is net financial asset, because your financial asset here is more than your financial liability. So only this figure, the 3,000 here, will be appear in your statements of financial position. Okay, and then let's say another example. Financial asset that you have here is 10. Financial liability that you have here is 20. So the difference that you have here 20, this 20 is a net financial liability. So only this amount will be appear in your segments of financial position. So it said that this exception means that using the offsetting positions here is only applied where an entity manage the group of financial assets and liability that net exposed basis as a part of the it documented risk management strategy. Actually, the standard do not allow for the offsetting, means that you cannot offset the financial asset with the financial liability. But if the financial assets and the financial liability exposed to the same risk, which is market risk and credit risk, then the standard allow for the net, the presentations of the net asset or net liability. To find whether you have the net assets or net liability, net financial asset or financial liability, depends on the value of your assets and the value of the financial assets and the value of the financial liability. In the first examples here, since your financial asset is more than financial liability, you're going to report a net financial assets of 3. The second example, financial asset is 10, financial liability is 20, so the net that you have here is 10. So the 10 here is considered as a net financial liability. Yeah? Okay. So that is what we call as a offsetting. Offsetting here means going to compare between, for the offsetting here, going to compare between financial asset and financial liability. Then you're going to report either net financial asset or net financial liability, either one. Yeah? So that one is for the financial instruments. Okay, and then the next part, we're going to look at the disclosure. So what the things that you need to disclose that enable user to access. Okay, so this is about the disclosure things that you need to disclose in the financial statement. So when you deal with the fair value, the first thing that you need to disclose here is about the valuation technique. Okay, what technique that you use to value the fair value, the assets? Either you are using the income approach, market approach, or cost approach, the techniques that you have. And then input that they use. Okay, input that you use, either that input is observable or unobservable. Observable, either that one is level 1 or level 2, and therefore unobservable here is a level 3 inputs. So that is the thing that you need to disclose in the notes to the accounts when you measure the assets or liability using a fair value methods. Okay, when you are using an observable input, means that if you are using the level 3 inputs to determine the fair value of your assets or liability, you need to provide the effect of the the effect of the measurement of profit or loss. That what is the significant effect, okay, of the use of observable unobserved input that could affect your profit or loss. Yeah. And then you need to provide a narrative discussion. Narrative discussion is a brief discussion on the sensitivity of fair value measurement that categorized within the level 3, because this level 3 here is more on the judgment. So when you use a judgment here, you need to explain a little bit here why you use that judgment method, and then what will be the effect to your income. Yeah. Okay, a quantitative sensitivity analysis also required for the financial instrument that are measured at fair value. You need to provide a quantitative sensitivity. Yeah? For this one is specific for financial instruments. Yeah? Okay, so that is what we have for a disclosure. Okay, this is a summary that we have. Okay, so we need to determine whether the item is in the scope. Okay, the first one we need to establish a parameter. To establish a parameter, we need to identify the items going to be measured, either that one is your assets or your liability. Identify the unit of account and the unit of valuation, and then identify who is the market participants. Yeah? Okay, and then for the approach for valuation technique that we have here, we have three methods. Okay, if you are using the market approach, then you are using the market will be based on the quoted price. Yeah. If you are using the income approach, example for the income approach here is a discounted cash flow. And then for the cost approach, you are using the replacement cost. Yeah? Okay, and then you need to determine the input. Input, we have three levels here. Level 1, okay, quoted price for identical asset. Level 2 here is a quoted price for a similar asset. And then level 3 here is based on the value, the judgments here. Example for this one is a discounted cash flow. Okay, for the measurement of fair value can be measured at the initial recognition, and then we're going to measure the fair value based on the highest and best use, which is based on the value that are viewed by market participants. Okay, the fair value also apply for the liability and owner's equity also, and then for the portfolio measurement exception, that if we have an active market. So the last part that we have here is about the disclosure about fair value measurements. Yeah. Okay, about the disclosure, remember that we need to disclose what method that we use, the input, and also the effect to your income statements if you are using the judgment inputs. Yeah? Okay. And then this standards, even though the standard is about the fair value, but this standard is not applied to IFRS 2. IFRS 2 here is relate with the inventory. This is relate with inventory, but I'm not familiar with IFRS 7. I can't 17. I can't remember this one. This one is for what? We haven't touched about this one. Okay, and then the standard also do not apply for the plant asset IAS 19. So this one is also not familiar with that. Okay, retirement benefits here is also not covered in any of your four. Okay, and then asset for which recover amount is at fair value less cost to sell. This is relate with the impairments. MFRS 1336 relate with the impairment. Remember that for the impairment, we need to determine the recoverable amount. So the recoverable amount here is either you are using fair value or you are using value in use. So if you are using the fair value, this asset is already at the fair value. So you don't apply the recoverable amount here is equal to the fair value. And then for the not required for the measurement similar to the fair value. So another things, then do not use the term fair value, but the treatment here is like a fair value. Example here is for the inventory. Okay, for the inventory, they are using net realizable value. The net realizable value is a similar what we have for the fair value, because you need to value the inventory using that like fair value minus cost to sell, also like this one also. And then regarding the IAS, the 136 must be the MFRS 136. Okay, when you determine the value in use, this value in use here will be based on the present value. So this one is not required for the using for the fair value. Okay, and then this is a question that you have at the end of the notes. Okay, I just want to find a request for the last time required you to find the answer for this one, but I'm not going to discuss this one first. We just settle with your notes, and then we continue. After this, we proceed with this one. Okay, we're going to skip this one for a while. Discuss. Just finish your note first. So now, any questions that you have for part 1 of your note? If not, we're going to proceed to part 2. Make sure that you have a note with you part 2. Any questions that you have for part 1? Any of you have a questions? For part 1, we already done for part 1. Part 1 here is more on the theory. Then we come to the part 2, and part 3 is an example from the theory that you learned in part 1. So means that you need to have both note, because part 1 is the explanations only. When we come to part 2 here is about the example. Can we proceed to part 2 there? Any of you? Can we proceed? Okay. So no question now for part 1, so we proceed with part 2. So just stop this one. Okay, so now we try to share. I'm going to share with you the part 2. Okay. Do you have this one, the part 2 of the notes? Yeah, do you have this one or not? Can you see this one? I cannot find where is the box there. Okay. So you have this one, already have the part 2 of your notes. So we proceed with the part 2, part 2 of the notes. I'm going to start from the beginnings here. Okay, so we're going to look at here the part 2 of your notes. Okay. So for the objective of part 2 for the notes here, okay, we just want to look at examples only. We have learned the theory in the first part, and then now we're going to look at the examples only. Okay, so for the examples that we have here, the first examples here, we're going to look at example is based on the step. First step. So if you refer here, we have the step here. The first one, the first step, we're going to have the example on how assets and liability going to be measured. Okay, the first step here is which assets or liability going to measure. And then after that, we're going to look at the principal and advantages market, highest and best use based on the market participant view. And then fair value for the liability and equity, and then fair value for unquoted security, and then example of evaluation models or approach that we have, the three approach, the cost, and then income, and also the market models. Okay, we're going to proceed with this one. Okay, we try to look at the first example. The first example is related with the first step. The first step, we need to determine which assets or liability going to be measured. Okay, so you have here ABC acquired a heavy crane 2 years ago. Okay, they acquired 2 years ago. At the end of the accounting year, the exit price based on a comparable transaction as a similar crane is 370. So you want to value your crane, but you don't know the value, so you don't have information about that value. So you are going to use the value of a transaction for a similar crane, which is 370. So that is a value based on the market participant value. To sell the crane in its principal market, so remember that when you want to sell the cranes, you need to go for sell the items, you need to go to the principal market. So in this case, it already mentions the principal market, means that you don't have to find for the advantages market. The transportation cost was say 20, and then the sales commissions were 25 need to be incurred. Okay, so you have two types of cost here, transportation and sales commission. Sales commission here is example of a transaction cost. Okay, so now you need to determine the fair value of the crane. Okay, to determine the fair value, remember that we have a formula for the fair value. Okay, the fair value here is a difference between your exit price or selling price. Okay, exit price or selling price minus transportation cost. Okay, so the selling price, okay, the selling price, since we don't want to sell, just want to know the fair value, so we need to use the value from the simulacrum. So the value from the simulacrum, we have 370, and then minus the transportation cost 20, so you're going to have 350. So this 350 is the fair value of this crane. Yeah? So this is what we have. Yeah? So when we want to determine the value, the fair value, we only minus the transportation cost. It said that here the sales commissions is not a characteristics of the crane that market participant would consider, because market participant only consider about the locations of the asset. When there is a location of the asset, is deal with the transportation cost. They only consider about this one. So you need to refer back to your slide, first part, that what market participant, what is the questions that are always asked by market participant. One of the questions here is relate with the location, because the locations here will determine the transportation cost. Okay, so that is what we have for example 1. Okay, we're going to proceed for the second example. If you have a question, please ask us that one. Okay, we will move to the next example. So example 2 here is about the principal and most advantageous market. Okay, so ABC has a special equipment, okay, that is used in the manufacturing process. So you use that one in a manufacturing process. ABC need to determine the fair value of the equipment. So they need to determine the fair value for the purpose of impairment testing. So they want to conduct the impairment test, so they need to know the fair value of the asset. Okay, so the similar equipment, so this equipment will be based on a value from a similar equipment. The similar equipment which are traded in a dealer, retail and wholesale market. There is a similar equipment that are traded, similar equipment to this special equipment was traded in a dealer, retail and wholesale market. ABC can access and trade in the first two market, but not in the wholesale market. So you cannot consider the wholesale market here, because ABC can do not have an access to that market. So this is what we have for the trading price and volume. So okay, for the dealer market, the price is 10. And then entity specific volume. Entity specific volume is referred to the dealer itself or retail itself. Okay. So entity specific volume here is 65, and then total market volume here is a total the total market itself at 20%. And then for retails here, the price is 9, and the entity specific volume here is on 35, and then the total market volume that you have here is 70. So in this one we cannot assess, so we don't consider about this one. Just need to compare with these two, which one is at the principal market. We said that the principal market with a high level of activity or volume. So in this one, the volume that we use here is a market volume. We are using this one, not the entity volume. So based on this one, the dealers and retail is same set. The retail have the higher volume, so the retail become a principal market. Okay, so with the second example. So remember that if you have entity and market volume, the one that we use here is a market volume, not the entity volume. Okay, so the principal market will be the retail market. Okay. So move to the next example, example 3. Okay, before the example 3, I just want you to amend a little bit to your notes. So this one will be DEF. Okay, and then exclude the word not here. Delete this one. Okay, so now we'll look at this example. So now, first thing that you need to do here is to change the word ABC to DF, and then delete the word not there. Okay, so they proceed to this example. Okay, DEF, buy and sell asset N in the US and the Asian market. So this is what you have. You mentioned for the Asian market and also for the US market. Okay, now you need to determine the most advantageous market for DEF and then what is the fair value. Okay, we have this market. So if you look at here, since the question only want to know about the advantages, so before that, you can determine the principal. The principals here, we're going to look at the highest volume. If you can look at the highest volume here, the Asian market will be your principal market. Yeah, principal. Why Asian is a principal here? Because Asian has a highest volume. Yeah, so the highest volume, so Asians become a principal market. But the question want to determine the most advantageous market. Okay, so for the most advantageous market, we need to look at the highest net proceed. Okay, to find the highest net proceed here is a selling price minus transportation cost. Okay, transport, and also minus the transaction cost. Yeah? Okay, based on these informations, okay, we go for the US market first. For the US market, the price is 100 minus transportation 10, so you have 90 there, and then minus transaction, you have 3, so the net proceeds here is 87. Okay, now we're going to compare with the Asians market. The Asians you have 95, and then the transportation here is 7 minus that figure, and also minus 2 here you have 86. As compared between Asian and the US market, we're going to choose the advantages here is based on the highest net proceed. So the highest net proceed here is from the US market because we have 87 here. So which one is the most advantageous market? Will be the US market. Yeah, US market because we have the higher net proceed. Okay, highest net proceed. Okay, and then what will be the fair value? Okay, the fair value here is the difference between your selling price minus the transportation cost. Okay, so since we already decide that the US market will be the advantageous market, so to calculate the fair value, you need to use information from the US market. So US market, the price is 100, and then the transportation cost is 10, so the fair value of the asset ends here will be 90. Yeah? Okay, although the EF principal market is Asian market based on the gross volume, the most advantageous market is the US market based on the net proceed, yeah, including the transaction cost. Yeah. Okay, the most advantageous market is given with the market that has a highest net proceed. Yeah. Okay, so this is what we have for the examples on the principal and most advantageous market. So any questions that you have for example 3? Any questions? Any of you? Imran, are you still there? Naura, still there? Any of you? Okay, so can we proceed to example 4? Okay, so we proceed now, Atika. So the next one, we're going to proceed for example 4. So example 4 here, before I proceed to example 4, is relate with the fair value applications to liability and equity. We just learned about how we're going to measure the liability and equity. Now we're going to look at the applications, the fair value application for liability and equity. Okay, financial or non-financial liability or equity instrument remain outstanding after the transfer. That is the assumptions. Yeah, we still have the one after the transfer. The market participant will be required to fulfill the obligations of the transfer. The fair value should be measured using a quoted price if there is an active market, and then if observables. Okay, delete again the word not. Yeah, so because if you are using the similar or identical item, that one is considered as a observable also. If there one is otherwise, use a valuation technique. Valuation techniques is unobservable. Yeah? Okay, A and B still observable. So when you use a price that is for the identical item, and then the other one is using a similar items. Okay, for the liability and equity, we can measure either you are using the income method, valuation technique, the income, market, or cost approach. Okay, so market approach, normally we are using the quoted price. Okay, based on the market value or others relevant information in the market. Any information that you have in the market, so then you can apply for the market models or market techniques. Okay, and then for the income approach here, use a future amount to convert, such as a cash flow or earnings, dividend, to a present value. You need to convert your cash flow to present value, so you are using a present value techniques, using present value technique. So for present value technique here means that you need to have the present value tables. Okay, and then for a cost method, you are using a comparable cost to the value. Okay, either we use a replacement cost or you are using the book value methods. So this is three approach that we use to value your equity and liability. Okay, so this one is a special treatments on how we're going to measure the unquoted security. If the and then this one is focused on the valuations of the company. We want to value the company, but the company is not quoted company. So when there is a unquoted company, means that the unquoted company means that there is no market value of the shares. Okay, means that the company is not listed. So when the company is not listed, means that we don't know the market value of the shares. So if I don't know about the market value of the share, there is a few methods to value the company. So we have the first method is a cost method, or sometimes we call as an asset based method. So for the cost methods here, we use a net asset model. For the net asset models here is a different. When you have the word net asset here, formula for the net asset is a difference between asset minus a liability, which is equals to your equity. So this is the net asset minus liability, or you can use information about the equity. In this model, we also need to calculate for intangible value, and then this model is more useful a capital intensive business. Capital intensive business here, examples here, a construction company, they have a lot of machineries which is based on the capital intensive methods. Okay, and then method of valuation that we use for the cost methods here is based on the historical cost, replacement cost, or net realizable value. Okay, the second method that we use here is to earning or market approach. So for earning or market approach, sometimes it known as a market valuation. Okay, for a market valuation, we need to use a proxy company. Why we need to use a proxy company? Because the company that you want to value here is not listed. So you're going to use a proxy company. This proxy company, the one that you're going to select, should be in a similar industry. Okay, similar industry. And then they also have a listed, the company should be listed, and then they should have a market value of shares. Okay, that one can be used as a proxy company. Okay, so the important things that we need to know for the market approach here, we need to know about the cost of equity, the PE ratio, dividend yield, and also the returns. Okay, that is the second method. So later on, we're going to look at the applications of these three methods. And then the last method that we have here is the income approach. Okay, for the income approach here, we have two different methods. The first method is a dividend growth model. Okay, and then the other method here is a discounted cash flow. So for the income approach, we have two methods here: dividends or growth models, and then the other one is a discounted cash flow. Okay, for a dividend growth models, and then we use a dividend growth model and dividend yields. This is based on the theory that the value of the company is based on the discounted of sum of all its future dividends payment. We're going to discount based on the future dividends payments. Okay, and then the other method that we have under income approach here is valuing a business based on a discounted cash flow. Okay, discounted cash flow here, we need to find its present value. Means that you need to use a PV table, and then this PV table, the interest here will be based on the weighted average cost of capital. You need to know the interest here. Okay, so two models or two approach under income approach. We have dividends model, growth model, and then the other one is a discounted cash flow. Okay, so we try to look at example 5. Okay, example 5, example 6. Okay, and the end here is about starting from example 5. Example 5 onwards here is how we're going to value a company. Value a company that is not quoted. Okay, or value unquoted company. Yeah. Without unquoted means that the company do not have a market value of shares. Yeah. Okay, the first method that we have here is a net asset model. Okay, for the net asset model, we're going to focus on the net asset. Okay, the model itself is so called as a net asset model. So the net asset model, we're going to compare between asset minus your liability. Yeah? Okay, so in this example, for this company, the asset that they have here is 32. Okay, that is 32 using this figure. And then you need to find, Ravin, what do you have that 999 for? Okay, and then you need to know the amount of liability. The amount of liability, you need to total up these two figures. You're going to have here 12.8, 12,800. Okay, so now we're going to use this formula. Okay, for this formula, it's a difference between asset minus liability. So liability that you have here is 12.8. 12.8. So the amount that you have here is 19.2. That is your net asset. Okay, if you look at here, this amount here is equal to the same amount as your equity. Okay, similar. Either you want to use this one, asset minus liability, or you can use directly the amount of the equity. Okay, so the net assets here will be 19.2. Okay, I just want to, okay, the question asks you to calculate the value of one ordinary share. Okay, the 19.2 here is a value of company as a whole. Value of company, okay, as a whole. Company as a whole, yeah. A whole company going to be valued at 19.2 millions. Yeah. Okay, but the question asks you to find the value of one ordinary share. So how are we going to find the value of one ordinary share here? The value of the company. Okay, find the value of the company, divide by number of shares. Okay, where is the number of share? Where you can find the information about number of share? You look at here. Okay, the total amount of your shares capital here is 8,000, and then it said that the nominal value, the par value of that shares is 1 ringgit. So 8,000 divided by 1 ringgit here. So you're going to find 8,000 units, yeah, 8,000 units of share. So to find the value of one ordinary shares, we are using here 19,200. This is a formula. 19,200 divided by 8,000. So to find the value per shares. Okay, this is what we have. Already calculate to you. So this is what you have. 19,200 for the value of the company. This is the value for the company as a whole. Value per share is 19,200 divided by 8,000. So you're going to have 2 ringgit and 40 cents. Okay, so that is what we have. Any questions that you have for example 5? Example 5 is a simple answer because you just compare between assets and liability, or just look at the amount of the equity itself. Okay, other than that, any questions that you have for example 5 before we move to the next examples? Any of you have questions? 5 is simple, isn't it? Okay, so can we move to example 6? Any of you? Okay, no questions, so we move to example 6. Yeah? Okay, example 6 still the same. Same using the net asset, but this time we have an adjustment. I said that because normally adjustment can be done to make an estimate value. So now we're going to look at an adjustment. Yeah? Okay, the same example that we have here. Okay, Ray is in considering to take over bids for AMD, and then AMD have been making loss for the last 2 years, so it's considered that the net asset valuation method will be appropriate to value the business. Okay, we cannot use the market models here because this company have making a loss, so making a loss normally the market value of the share also have a loss because yeah, but in this case the MAD here is if what we have here at the end of this one, I cannot see this one. Okay, just a little bit. Okay, so this company is not listed company, yeah, so Sendirian Berhad company is not listed, so we want to value. Okay, so the value the company because Ray in the process of, okay, Ray going to buy the, okay, going to buy AMD. So they're going to value the MMD. How much they need to pay for to buy the AMD. Yeah. So this is the in financial position that the AMD have. So, but you look at here. You look at here, there is a note here. When there is a note here means that there is an adjustment. Yeah. Okay, so note 1, you have the amount for the non-current asset is 1207. Yeah. Okay, and then okay, later on we look at the adjustment. What is the notes here? Okay, so the total amount of this one 1771 is your total asset, but you cannot use this one because of the adjustment, so we need to look at the adjustment first. Okay, just look at this information that you have. So you have hundreds thousand, hundreds thousands of the shares capital, so means that in terms of these hundreds divide by 1, so you're going to have also 100,000 units of shares. Okay, because why we need to know this information here? Because you want to calculate the value per shares. Okay, after this, and then you have returns earning, and then you have a bonds payable, and then a liabilities here. If you look at here, this is your equity, yeah. So your equity amount here is 653. Okay, and then you cannot use this figure because the asset has an adjustment here. Okay, and then you have for the liability, total up the amount of liability. The amount of liability here will be 1118. Okay, so you need to know this information. So, okay, so we proceed. Okay, now we look at what is the thing that you have for the notes here. Okay, so I cannot see this one. Can you put a little bit down? Okay, so notes 1, this asset comprise. So note 1 is relate with the non-current assets. If you look at here, the value of your non-current asset previously, the value of your non-current asset was the value of non-current asset 1027. Okay, so for non-current asset, based on the balance sheet, here the value is 1207. Okay, we said that this asset comprise a specialized manufacturing equipment. To replace it, it require additional cost of 1.5 million. Okay, 1.5 million. So this is, what is this 1.5 million? This is a replacement cost. Okay, but if AMD to be closed down, the asset would sell for not more than 1 million. So what is the, if you want to sell that one, if you want to close your business, you will need to sell the asset. So the asset worth is only 1 million. So this one is a forced sales. Okay, why this one is a forced sale? Because you want to terminate your business, close down. Yeah. Okay, so now which we have a difference value here. Replacement cost here is 1.5, for sales here is 1 million, and then from the balance sheet figure here is 1.2 million. So which one that we going to use as a fair value for this non-current asset? So model that we use to value here is based on the cost model. So for the cost model, the important the things that you need to know here, we should base on the replacement cost. This one will be the fair value. We cannot use this for sales here because this is not an orderly transaction. You are forced to. So which figure that we're going to use here is from 1.5 million. So this 1.5 million will be the fair value of your non-current assets. Okay, and then the other things, note number 2. Okay, for notes number 2, there is a receivable. So receivable amount of 120 from large customer has just gone into liquidation. So when this customer was gone into liquidation, means that this receivable has an impairment or reduce in value. So means that you need to minus because of the impairment. And then it said that the contract from the same customer include work in process inventory at a value of 30 will now have to be scrapped. So the inventory has to be scrapped. So scrap here means that going to be minus also. Okay. So what will be the expected fair value of AMD using the net asset value? So now we're going to value here. Okay, your non-current assets here, you are using the value of 1.5 because this one is based on a replacement cost. We don't use 1207, we are using this one. Okay, because of based on the replacement cost. If you need to buy from a scratch, the specialized item or machines here cost 1.5. Yeah. Okay, and then the current asset, this is the amount that you have in the balance sheet. You minus 120 here because of the impairment for your receivable, and then minus another 30 here because of the inventory. So now the value become 414. So you total up these two figures because this is your asset. You're going to have 1914. 1914 total up, compare with your liabilities here. Liability is 118. So the difference that you have here is 796. So total up these two figures for the non-current asset and current asset to find the total asset. And then for liability, you total up, already total up, that one is 1118. So compare between assets and liabilities. So you have 796. Okay, 796 here is a value of company or value of AMD. AMD. Then we're going to find the value per share. So the value per share, this figure divide by, just delete 10 here. Okay, because the total number of share here is only 100,000. So 796 divided by 100,000. So you have 7.96 ringgit per share. That is a value per share. Okay, any question for example 6? So means that when there is an adjustment, you need to read the notes. Okay, what is the adjustment that you need to do to the assets and also to the liability? If there is any adjustment related with the liability. In this example, is adjustment to the asset value only. Okay, any questions that you have for example 6? Any of you have a questions? Please. Questions? No questions. So understand, huh? This is a problem that we have for the online class. Okay, nobody's going to answer, nobody going to unmute the mic, so I just talk alone. Okay, so who answer this one? Up to this one, no, not yet. Okay, Naura, only Naura, Shafiqah, Imran sometime. Okay, so never mind, just proceed with this one. Okay, the next one, we look at the next one. We're going to look at the examples here. Okay, the next method that we use here is the income the earning methods. Okay, for the earning methods or the market method, we're going to use a proxy company. Okay, I just want to make a little bit amendments to this note here. Okay, sorry, the notes for this one, you just delete this one. Delete this one first. Delete this one. Okay, so this is the formula. The value of the company here is equals to earnings time with a PE. PE ratio. PE here is a PE price earning. The one that I mentioned, PE here is means that price earning. So to the value of the company, so value of company. company here is equals to earnings. Okay, earnings time with PE ratio. PE ratio that we use here is a PE ratio for a proxy company. Why we use, because okay, to find a PE ratio, formula for PE ratio, this is a formula for PE ratio, is a market value of shares, okay, or the price of shares divided by earning per shares. Okay, since this is example of unlisted company, you cannot find the market value of the share, so that's why you, in the bracket that you have here is a proxy company. So the market value of shares that you're going to use here is from a proxy company. Okay, for unlisted company, the value usually lesser than the amount that you calculate here. Will be two-thirds of the PE from the listed proxy company. Later on, we will look at the example that you understand, yeah, about these two-thirds and whatever that. Okay, the thing that you need to know from this note, how to value the company is using the formula. Earnings time with the PE ratio. The PE ratio, how to calculate the PE ratio is using this formula. The market value of share divided by earning per share. Where these informations come from? Come from a proxy company. Yeah? Why we don't use the company itself? Because the company is unlisted company. So once this is unlisted company, means that there is no market value of shares. We cannot use that one. Yeah. Okay. So now we want to value the unlisted company. Yeah. So PQR is a successful unlisted, okay, unlisted firm, game software and development firm. And asset-based valuation is not appropriate as the value of its key asset. We cannot use the cost method because the asset cannot be determined. Yeah? Okay, the asset which is a game and development team are not reflected in the balance sheet because this one is related with the intangible asset. You cannot measure that one clearly, the precisely, so you need to use another methods. Yeah, a similar, okay. A similar listed company has recently floated in a stock market. So a similar listed company means that this company is in the same industry like the PQR. Okay, and then this similar listed company recently floated in the stock market. When there is a recently floated in the stock market, they're going to have the market value of share and then also the earning per share. So a similar listed company going to be used as a proxy company. Yeah, this is a proxy company. Okay, so for this market, for this similar company, okay, it has an earning per share of 50 cent and the current share price here is at 10. Okay, the PQR earns profit 1.2 million per annum. So profit or earnings, same thing. Yeah. Okay, calculate the value of PQR based on the information that we have here. Now we need to calculate the value of PQR. Okay, from here, the first thing you need to calculate the PE ratio. Okay, the PE ratio based on the proxy company. So the PE ratio, we are using the market price of the share, which is 10 ringgit, divided by 0.5, which is the EPS. So the PE ratio here is equal to 20. Okay, now we can apply the formula. So the earnings here is 1.2. Okay, earnings here is earning for the company that you're going to value. So the earnings here is 1.2 time with the PE ratio. PE ratio we already calculate 20 here. So the amount that you have here is 24 millions. Yeah. Okay. That is a 24 millions that you have. This is the one that you have. Okay. So okay, the value of PQR here is 24 millions. Okay. Based on the one that you have. This one is a PE ratio. You calculate the PE ratio. Okay, and then time with earnings. Earnings here is 1.2 million. Okay, for unlisted company, the value is usually lower. Okay, and then two-thirds of the PE listed proceed as a judgment. Okay, so the fair value of the approximately will be two-thirds time with the value of PQR. So you're going to time with 10. Here is the PE ratio. Okay, time with what earnings here. So you have 16 million. So to make it that thing simple, so the value of PQR, okay, PQR here is equals to, okay, the value that you already calculate, 24 millions time with 2 over 3. Okay, which is equal to 16 million. So this will be the value of the PQR. That 24 million here is only a proxy, and then you need to time here 2 over 3 lesser. Why that one is lesser? Because as you the one that you use the information to calculate the PE ratio is based on the listed company. So normally the unlisted company will be lower than the value of, okay, the value of unlisted company will be lower than listed company. So from the information that you use is listed company 24, so means that the value of the unlisted company will be lower than this 24. How much lower here? Normally they give you 2/3. Maybe sometimes they give you 1/3. So if that is 1/3, then 24 million time with 1/3. This is depend on the questions given. If not given, then you are using 2/3. Okay, so that is the one that you use normally. This one is given. Okay, to calculate the value of the unlisted company, the amount or the value that you already calculate here need to time with 2/3 or any ratios given in the questions. In this example, it give you 2/3. Because why we need to time with 2/3 or 1/3 here? Because the value that you calculate here, the 24 million is the value based on listed company. And then normally the value of the unlisted company will be lower than the listed company. So that's why we need to portion that amount to either 2/3, 1/3. It depends on the question. What we're going to mention in the questions. The important under the earning approach, you need to know the PE ratio. Okay, the PE ratio, the one that you use here is for a proxy company. The market value divided by earning per share. When you have that ratio need to time with the earning. Earning that we use here is earning for the company that you're going to value. So earnings in this case you have 1.2 million, which is earning for the PQR. Okay, so the value of PQR here is not 24. The value of PQR here will be this figure, this 16 million. This will be the value of PQR. Any questions that you have for this one? Any question? If the company is a listed company, we don't need to multiply. Yes, but for a listed company, you don't have to do this kinds of valuation because you can use a straight, remember that the first level input, you just use the market price. The market price time with the number of shares. Okay, so simple. This one we use only for the formulas here is only applicable for the unlisted company. If that one is a listed company, okay, if this is a listed company, okay, listed company, we just use the market price of the share. The market price here is 10 ringgit, 10 ringgit time with the number of shares. Okay, that is method that we use. Okay, so understand, the valuation here is only for the unquoted or unlisted company, because unlisted company we don't have informations about market price of the shares. Okay, my Sarah, okay, so understand, my Sarah. Okay, so we proceed now with the next example. Okay, the next example is relate with the income approach. So for income approach, we have two models: the discounted cash flow, and then the other one is a dividend growth model. Okay, for a dividends growth model, we are using the Gordon growth model. Gordon is the name of person. So this is the name of person who developed the dividend growth model. So we names this model as a Gordon growth model. We have two formula for the growth model. The first one is we assume that it's constant dividends. So the formula here, P here is the value of the company or the value per shares. And then D here is a dividend, KE here, D is a dividends, and then KE here is a returns. Okay, returns. Okay, and then for a constant growth, okay, this constant growth. This is a constant dividend. This is a constant growth. Two different things. Constant dividend using this formula. Constant growth, we have this formula. Okay. Okay. So you not constant growth. Supposed to be change again. This one growth dividend. One is constant dividend. The other one is a growth dividend. Okay, not constant growth. Constant you cannot grow. Okay, so you have this one growth dividends. Okay, so for growth dividend model, the formula here is PO is equal to dividend time with 1 plus G divided by KE minus G. 1 plus G. G here is a growth. Okay, the growth rate is normally given. This one will be given in the questions. So we're going to apply this formula. Okay, so assume that MNO just paid a dividend of 250. Can I put it a little bit there? 250 euro. It has 2 million shares in issue. Okay, the current return to the shareholder in the same industry as MNO here is 12%, although it is expected that an additional risk premium of 2% will be applicable to the MNO. Okay, so in this situation, MNO, okay, MNO here is a unlisted company. So there is unlisted company. So then there is unlisted company. You need to use a return. To find a return here, you need to use a return from industry. So return that we use here is return from industry. So a return from industry that we have here is given here is 12%. Okay, we don't have this one. Okay, industry 12%. But look at here. It said that it's expected that there is an additional risk premium of 2% will be applicable to MNN. Okay, when you have a risk premiums here, risk premium need to add together with the industry returns to find the returns for MNO. The return for MNO here is a 14%. Where to get that 14? 12% for the industry, and then another 2% an extra return that you receive from the MNO. So you're going to have the returns here. So the K here will be 14%. If there is information about risk premium. If there is no information about the risk premium, so the K that we have here is only 12%. Okay, so we need to calculate the the fair value if the dividend is expected to be constant, and then if there is a growth of 4%. Okay, the first one is a constant dividend. Okay, and then for the constant dividends, okay, you're going to have this one is growth dividends. Okay, for a constant dividend, you just apply the formula. The dividends, the value here is the fair value here is a dividend. The total dividend paid here is 250. Okay, and then divide by KE. KE is the returns. Remember that the returns here is industry plus premium, additional risk premium. So you're going to have 14%. So the value here, the value of the company will be 1.786 million. In terms of shares, you need to divide with 2 million here because you want to find per shares. So in terms of per shares that you have here will be 0.893. That one is in terms per shares. Okay, and then we look at the growth. So this is a formula for the growth. For the growth here, you have dividends time with 1 plus G. So 1 plus G here is 1 plus 0.04. So that's why we have 1.04 here. Because the growth here is 4%. And then KE minus G. KE here is 14% minus growth is 4%. So you're going to have here is equals to 2.6 million. 2.6 million. And then in terms of per share here, 2.6 divided by 2. So 1 ringgit, in terms of euro will be 1.3. If you compare between these two methods, the growth models, okay, the growth model we provide the higher value as value of company as compared to constant models. Okay, The growth model going to have more, going to provide a higher value of the company as compared to the constant model, because you consider about the growth here. Okay, so this is the two models, the constants and the growth models. Okay, any question for this two dividends model? Okay, if no questions, then we try to look at the cost model. Okay, you think, okay, if you have a question after this, you can that one. Okay, we try to look at the cash flow models, another model for the under income approach. Okay, for the discounted cash flow, okay, under income approach, we have discounted cash flow. A value of company equity is derived by estimating a future annual after tax cash flow. So the things here, you need to be careful with this one. I give you the cash flow. This cash flow should be net after tax cash flow, and then discounting this cash flow at appropriate cost of capital. Cost of capital or discount rates here is normally given. So that is what we have. Okay, so we need to know information about the cash flow. The cash flow should be net after tax, and then we need to discount it. Discount it means that we're going to apply a present value tables. Okay, we need to know the present value. When we want to discount, we need to know the present value at the appropriate cost of capital. Okay, we try to look at this example. Okay, the expected after tax. Okay, this one is already after tax, so you don't need to do any adjustment. If that one is gross, then you need to minus the tax. So this is the expected cash flow for DEF, okay, of the 2 million shares. So this is what we have. Okay, for the first year, the amount that you have here is for all equity finance company with 2 million shares. Okay, so expected, this is the amount of expected cash flow. In the year 1, you can receive 120, year 2 is 100, year 3, 140, year 4 is 50, year 5 onward is 130. What you mean by onwards here? Onwards here means that from starting from year 6, 7 until infinity, okay, infinity, the cash flow, the cash flow will be 130. Yeah? Okay, that's why you have onwards there. Okay, and then the suitable cost of capital here is 12%. So 12%, we're going to apply this 12% to calculate for a present value. Okay, calculate the value of DF using a discounted cash flow valuation models. Okay, so look at this one. So if you look at this one, okay, so this is the amount of cash flow. This is the amount of cash flow, cash flow that you receive for the first year. Discounted factors, you're going to use a PV tables. Okay, the interest here is 12%, and the end here is equals to 5, because we have information up to year 5 here. So from that table, you find that for the first year, the factor is 0.89, the second year is 0.7, the third year is 0.71, next year, year 4 is 0.6, and then year 5, 130. So 0.567, yeah. So to find a PV, you need to time these two figures. Time with these two figures, yeah. So then you're going to come up with this PV. So you have here 107, 79, 99, 31, 73, total up. So the total up all this PV here is the PV from year 1 until year 5. Okay, year 1 until year 5. Okay, look at this one. Please be careful about this one. Assuming that after year 5, the cash flow is infinity. So when the cash flow of is infinity, you need to calculate the present value for that cash flow. How to calculate the present value of that cash flow? The first thing you need to find the cash flow, infinity cash flow. The infinity cash flow, the formula for this one, you need to use a cash flow for the last year. So the last year that you have here is cash flow for the year 5. Yeah? The last year is the year 5, divide by returns or cost of capital. Okay, returns or cost of capital. So you're going to have here 130. This one is to find the infinity cash flow. 130 divided by 0.12. And then you find the amount here is 1089. 33. Okay, and then this is a cash flow. This is the amount of cash flow. Then this cash flow need to PV, present value. So the present value that we use here is a present value figure at year 5, the last year. So the present value at year 5 here using this one is 0.567. So this one, so 1.083 time with this figure, so you're going to have 614,250. That 614,250 is a present value for the infinity cash flow. Okay, and then to find a total present value, you need to total up these two fair value, the present value. The present value of infinity cash flow, okay, plus the present value from year 1 until year 5. So you found that the amount here is 1.06. 1.06 is the fair value based on the discounted cash flow. Okay, then we want to find the value per share. So the value per share, the fair value here divided by number of shares to million, which is equals to 0.50 cent, 50 euro per share. Yeah. Okay, any questions that you have with this one? I'm going to keep this one for a while. If you have questions, I just want to finish with your notes. And then after this, I'm going to allocate some time for you to ask the questions. Yeah. Okay, so we proceed for the last two slide, I think. Okay, the other methods under the cash flow, under the income, before that you look at the discounted. And then another things that we use for using a cash flow is a use of range of cash flow and incorporate the probability. Okay, this time we want to calculate based on the probability to measure the fair value. The cash flow estimate will be based on the own experience or based on the professional or independent assessor. Okay, so this is another method to calculate the cash flow. The first method here is using the present value. The second method, we are using the probability. Okay, let's say for the asset of machines here, the probability of cash flow here is 100% is 30%. Sorry, 100,000 is 30%, 200,000 is 50%, 300,000 is 20%. Okay, this is a probability that we have. Okay, this is a probability, this is a cash flow. Okay, so based on traditional model, for a traditional model, we're going to estimate the fair value based on the highest probability. So the highest probability here is 50%. So the fair value here will be 200 based on this figure. That one is a traditional method. But we're going to look at the second method, which is expected cash flow. We are using this method, expected cash flow. So for the expected cash flow, you need to, for the expected cash flow, you need to have cash flow time with a probability. Okay, so the cash flow, you have the first one is 300. So 100 time with 30%. And then the second one, 200 time with 50%. And then the last cash flow, you have 300 time with 20%. So you total up here 190. This 190 become your expected fair value. So to calculate the cash flow, either you are using the present value method or you are using the expected cash flow based on the probability. Yeah, but for the we're not going to use the traditional method. We're going to focus on the last method here, the expected cash flow. So based on the slide, I think this is the end of the slide. So any question with any example that you want me to explain again? Which one? Okay, I like it some few times for you, a few minutes, 10 minutes. If you have any questions, okay. If you have any questions, please look at the example that we already discussed. Do you have any questions regarding the examples? Okay, so while you are thinking about what you're going to ask here, I just want to remind you for the next class, since we're going to miss this Thursday class, so I better for me to finish all the notes. Okay, so for this coming Monday class, okay, coming Monday class, I want you to to or answer the 4 questions that you have at the end of part 1, and then I'm going to provide you with an exercise on this the model that the methods that you have to value the company, and then please do that exercise. And then the last thing here, we have another part 3 of the notes, also an example. Some of the example is already discussed in your notes. Maybe we're going to skip some of the examples, so we're going to discuss the example also, but only the one which is not in your notes. Yeah, so 3 things that we're going to do for the next class. One is on the 4 questions. You need to answer that 4 questions, and then the other one is prepare the answer for the exercise that I'm going to provide, maybe tomorrow, not today. Okay, I'm going to find the questions so that you practice for the method that we have here. And then the last one is on the example. Please read the examples here, because the example there is quite complicated, because it gives you in terms of text, so you need to understand every words that you have in the examples. Okay, so any questions that you have with any of the examples that we discussed previously? Any questions? Sorry, it take about 1.5 hours, because I just want to finish all for today's class so that you can prepare for the exercise. Ajma said no questions. No question. Ajma, so you understand everything that we have in the notes. For question, which one? Part 1 of your notes, remember that the one that we skipped previously? Okay, the theory questions. Okay, and then what else? Another questions that you have. So this one is quite complicated. Example on the discounted cash flow. Do you have any question on this one? Yes, but not today. Maybe tomorrow about the recording one. Okay. Other than that, do you have any questions related with the discounted cash flow? Yeah. The rest is simple except for this one. Exercise is based on this part. Yes, based on topic 4. Topic 3 on the fair value. That one is exercise on how, whether you understand the example that we give you. Okay, the one that we discussed today. Okay. Other questions that you have? Okay, for those who do not have any questions, you can leave the meeting. For those who want me to add you manually, I think that all of you already scanned for the attendance. Okay, and then okay, for those still have a question, you can, I'm still here. I'll wait for your question if you have any questions. If not, the rest you can leave for the meetings. Okay, it's up to
Doctor,
you. Yep.
if the question only asks to calculate the value of the company, do we need to calculate the value per share too?
Value of the company. Okay, value of
Yes.
company, no. We just calculate up to the fair value only. So value per share, if the question asks you to calculate for value per shares, it's simple, isn't it? To calculate the value per share, once you have the value for the company, then you just divide by the number of shares.
Okay, thank you, Doctor.
But most of the time, they are going to ask you both. Calculate the value of the company and also the value per shares. Okay, other than that questions? Okay, for those who want to live, you can live now. But for those who still have questions, you can ask questions. I'm still here.
Doktor, saya nak tanya berkenaan dengan sisi 1.
Tak habis lagi sisi. Apa dia? The questions.
Soalan 10 dengan soalan 12 tu,
Questions, okay.
polisi untuk untuk non-financial
Because that one is under
And soalan 12,
12 is specific to the
financial asset.
financial assets.
Okay. Okay. Terima kasih, Doktor.
Okay. Other than that, any other questions? If you want to live, you can live the meeting for those who not have a question. But for those who still want to ask questions, any question? I'm still waiting for your questions here. So, what the example is okay, you can understand the examples. If you don't understand, please ask that one. Okay. Okay, I try to bring this one a little bit. Okay. If the company does not have impairment loss, should we write the company does not have impairment loss? Okay, my Sarah. Okay, if you read the CC section 1, it said that you should choose a company that have impairments of asset. If you don't have impairment of asset, means that you don't have impairment loss, isn't it, my Sarah? So if you don't have impairment loss, then how can you do for the CC1? Because the first requirement required in section 1, you should find a company. Item number 1 there mentions that you should find a company with impairments of asset. Okay, so if you don't have impairment loss, okay, the company going to do the impairments. Okay, if there is no impairment loss, means that you don't report any impairment. So how you don't fulfill for the first item in section 1, isn't it, Mas Sarah? So means that you need to find a company with an impairment. Okay. Other than that, any other questions? Okay, my Sarah, okay. So try to find another company. So if you cannot find a company from else, letters L, you just check your friends what the company they already choose. If you cannot find from the L company, you can go for company that start from U until Z. Any company from them, because nobody use that company. Company that come from letter U until Z. Okay, if you cannot find from L, choose company from U until Z. If you cannot find from L company, okay. Other than that, okay, for those who want to leave the meeting, you can leave. Okay. I'm going to wait for another few minutes. Okay, maybe another 3 minutes. I'm still waiting if there is any question from your friends there. For those who want to leave, just leave the meeting. Okay, my Sarah, okay. Okay, thank you all. So just want to add, if you are still here, so if you want to ask anything, okay, my Sarah, I'm going to add you manually. Mm -hmm. Others, if you have a questions. Okay. Okay, so you already left the meetings, yeah? Okay, my Sarah, I'm going to add, I cannot access to the portal. Okay, once I can access to the portal, then I'm going to add you, my Sarah. Now, okay, wait, I cannot access to the portal now. Just wait for a while to try to access that one once again, yeah? Okay, Naura and Masara. Okay, I'm going to add both of you manually, yeah? Okay. So done, huh?
Okay, doctor, thank you.
Okay. Number 10, where they set the policy, they state the policy, you can read that one from notes to the accounts. Okay, or policy of the company. At the end, significant accounting policy. Okay, at the end, they use maybe it's a different word that they use. The significant accounting policy or notes to the accounts, you can read from that one what policy they're using, how they measure the impairment. I think most of the company measure the impairment is similar. They compare between the cost and the recover amount. So the different maybe in terms of recover amount, whether they are using the fair value or they are using the value in use. Okay, Read the notes to the accounts. Sound how to pronounce your names here. Santanya. How? Okay. So check from there. Okay, so no more questions. So thank you. Okay, so see you maybe
Doktor.
next week. Okay.
Doktor.
You,
Siap.
I cannot hear you. A
Okay,
little bit louder.
Kira terdengar tak?
Huh?
Hello, doktor dengar tak?
Dengar. Tapi kuat sikit. Tahu apa nak dengar. Okay.
Okay, sorry, mic saya slow. Okay. Saya nak tanya soalan yang sisi tu, sisi 1. Sisi 1 and then question nombor 13 tu. Question tu dia tanya tentang ni, explain the factor macam mana impairment tu berlaku. Tapi saya tak jumpa dalam AR. Adakah dia macam relate dengan kita punya polisi atau macam mana untuk factor dia tu?
So, okay. The company wants to do the impairment, isn't it? You already find the company that has an impairment. Okay. So, to set impairment, what kind of indicator that they said that they have impairment? Remember that you have two things or two factors. Actually, not two factors. We have many factors, but the factors is there through the external factors or because of the internal factors. They're going to mention that one. Why they do the impairment? Because of the market condition, the asset value have been reduced. So this is example of the policy that they use. See, okay? The one who asked.
Oh,
Okay, can you find that one?
okay.
Imran, isn't it?
I will find it first.
Imran nampak tak macam mana nak jawab yang tu? Okay, you can tengok
Setakat
balik
ni
nota
nampak
you.
lagi.
Tengok balik dekat nota tu. Kan dia ada factor-factor yang lead to impairment. So, company tu mesti mention. Kenapa dia buat impairment, apa polisi yang dia pakai. Polisi dia, bila ada reducing in the value, then we're going to conduct an impairment. So, that is what we have. Is it okay?
Okay. So dia memang still relate lah dengan polisi company tu kan?
Dia relate dengan polisi company tu.
Okay. Thank you, doktor.
Okay.
Nampak dah.
Okay. Okay, so thank you. Only Naura left. Okay, Naura, so now